So we had a down day today, about as small of a down day as you could possibly have, despite how bullish of a trend that we're on right now. So very small range, very tight range, a little bit of a jump in volatility, so that can be a little bit of a red flag added to all the other red flags we've seen lately. And also there was a breakout on the dollar, and that was a significant move today. And if this breakout holds, that can change some things. So I'm going to talk about that, as well as the rest of the technicals and all these signs of maturity that this trend's having and what we can expect going forward from here. We're also going to talk about the sectors and how different sectors are performing here differently, and where we might be able to still see some strength and some opportunity to ride this bullish trend. So let's go ahead and get started. Today is Wednesday, April the 24th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. Alright, well, let's start off taking a look at the S&P 500 here with the Market Forecast Indicator, and we'll update these Fibonacci retracement lines, since apparently we'll never end up using them. At some point in time, right? At some point in time there will be a retracement, unless this is like the magical market that never retraces ever again. Alright. But you can see now where the 23% Fibonacci retracement is lining up, right on with that 2,800 level, these old highs, multiple touches in this area, and of course the 38% Fibonacci level down to 2711. Just to kind of give you an idea how far of a pullback it'd be just to get a 38% Fibonacci retracement, which is very, very typical. It would end up being, from yesterday's high point, a 7.5% move. So that would be pretty uncomfortable for a lot of people, and yet that would be 38% retracement and be very normal if that happened. Of course, it's because of how big the rally has been that would make it such a big number there. But you can see a little tiny pullback today. You can kind of see that's the pattern. Is we get a big breakout move, we go sideways. We get this was a big breakout move in the overnight, and then we went sideways. We get a big breakout move, and so far going sideways, at least at the top end of this new breakout range. We small 6-point range, 6-point move, 10-point range. So it really wasn't much of a range today, and the average range at that 21 points is really, really low as it is. So we were half. We had half the range of what is already a very low average to begin with. So in other words, I mean, there's nothing going on, nothing in the news, even in the middle of earnings season, not a lot to really get the market going after yesterday's kind of breakout to what it was on the S&P 500, a new all-time closing high. You see that the near-term line did get up in the reversal zone, so about as high as it got last time. It is a higher high, it is a higher high point, obviously, and it's still a slightly lower high as of right now, depending upon where it ends up tomorrow. The intermediate posture is still strongly bullish. The long-term market sentiment still up in the up there. Remember, any cluster we get here, like we had early in the day yesterday, will be a quadruple cluster, right? And it will be 3 months plus into this current intermediate run. So just kind of keep an eye out for any clusters like this. See, these clusters occurred at the beginning of the intermediate run. The ones that occur at the end would be more are more indicative of a potential reversal pattern. So we keep our eyes on that. Obviously, the near-term line, you see the near-term line's only dipped below the 20th percentile the 2 times that we had these weak bearish postures, and that was really it. And remember, we still have this divergent low point on this intermediate line that we're bouncing off of. As I mentioned before, last time we bounced off of this one, we had a couple weeks here, and now we're going 3+ weeks into this bounce off the last intermediate weak intermediate low point, right? Not even a significant one. It'd be a weak intermediate low point that we had there that at the very least produced pink shading, light pink shading, which means that we were bearish but not below 50. Obviously, we got dark green shading. We have a dark green line that continues to show bullish trends. You can see same thing for the Dow Jones. It's not up to a new all-time closing high like the S&P, but it's getting closer. The NASDAQ composite, you can see it got up to a high today of 81.39. which is a highest all-time, it is the highest high point, intraday high point, unlike the S&P. And then of course Russell 2000, which is still not even above its its high point from February, much less its high of this 52-week high. So the Russell 2000 still showing some weakness and unable really to get, it's got dark green shading, it's at a dark green line, so it's showing a bullish trend, but it's not really able to get going. In fact, if you take a look at the trend strength indicators, and here go back to the 1-year chart on it, you can see that we are above 1, we are above 50, so that is a weak bullish pot trend according to those indicators down there. So not quite even a moderate trend, which is what happens when you get above 65 and 2 on these indicators put together. So you get an idea that we continue to show bullishness, but with the ranges really small and the volumes really small, then we just kind of grind. We kind of grind our way higher, even with kind of a bigger move we had yesterday. Typically, those kind of moves in this type of market are followed up by nothing moves, and that's essentially what we got today. Alright, before we look at some other charts, a reminder, subscribe to our YouTube channel. Click that red subscribe button that's down below the video there, or mouse over our logo here in the bottom right corner of your screen. Also, click the thumbs up icon down below the video. That tells us two things. Number one, you got something out of our video today. Number two, you want us to do the video again tomorrow. It's a quick way to give us feedback. You can do that right now while you're watching. Also, while you're down there, comment what stood out to you from today's video. Love to see what you got out of it. Join our daily market outlook email list. There's a link popping out in the top right corner of your screen up there. Click on that link to subscribe. Follow me on Twitter for more content like this in between videos from day to day, and also join our market outlook community that we created on Facebook. Also, if you're watching our video here on our blog, remember to like our Market Outlook tweet. Click on this heart. That will open up this little window. You can like tonight's Market Outlook tweet. You can also like today's Market Outlook post as well. Remember, the more you engage with us on these platforms, the more the Twitter and Facebook will push you all of our content that we put out there. That's how you let them know that you what content you want in your timeline among everything you follow. Of course, you can also like it right here. Click on this. So it's 3 clicks. 1, 2, 3 is what we look for. You can do that again right now while you're watching. There's our calendar for the rest of the week coming up. Brandon's Q&A session tomorrow, and then my portfolio management, my ETF class and technical analysis before the end of the week. Remember, you can click on this link or go up to the events to see the rest of our class calendar that we have for our premium subscribers. Also, you can participate in our Market Outlook forum right above the video, but you have to subscribe to our site. You can do that for free, and that will allow you to participate in that forum and be able to open or reply to any threads related to what we talk about in these videos day after day. Alright, let's get back onto the charts now and take a quick look at the long-term charts, and you can see again how bullish this week's candle is, mainly because of yesterday's move. That's why we had such a nice good rally here, again up to 29.27. The highest weekly close is 29.29.67, so we're almost there. In fact, we were there yesterday before this little pullback today. Of course, the Heikin-Yashi candles remain very bullish, so we'll end up with another bullish candle. No transition yet, right? We don't get the bearish candles without a transition first, so we know that next week won't be a bearish candle, most likely, barring a crazy move. And next week will most likely not be a bearish candle, most likely be at the worst a transition candle, kind of like this one here, or this one here. But you see we don't go from really bullish to really bearish, just like that. But you can also see too just how long we've been bullish without a bearish pullback. So it kind of just shows again how mature this trend is. And I mean, look at this. Like, if I were to zoom this out here and just kind of throw a, let me get rid of these lines that aren't relevant anymore, and I want to show you, this level that we're at, 86. Now remember, this is an absolute level. This is not a apples to apples comparison, but this kind of show you 86.96 where how bullish we are on an absolute basis. 86.96, sorry. You can see, it's not too often that we get this bullish. Now 86 points down here when we're at 1300 is a much different story than 86 points at 2900, right? So we're even double. So that, you know, it puts into the context here. The lines down below, the MACD down below, is an absolute value of the 10 and the 40 week moving averages that you see up here. The reality is, as bullish as we are now on a relative basis, it's actually not very bullish, because again, 87 points out of 2900. I mean, just kind of show you, 87 points out of 2915. I cannot type today. Is only 3%, whereas back here when we were at 87 or 90 points or so, 90 points out of 1323. 90 out of 1323. So that was almost 7%. The MACD was almost 7% of the current of the value. This kind of shows how bullish we were in 2011, or right before we peaked. All right, so you know, we're not even close to being that bullish now, and of course we were a little bit more bullish than this when we peaked here in September, and even this level we were a lot more bullish in early 2018 when we made that 5-month rally up to really strong levels. Of course, we were coming up off much higher lows compared to this low point. So this rally from minus 91 points to minus 90 points to 90 points is, you know, that's a pretty decent sized move in such a short amount of time in terms of long-term momentum, which is what that measures down there. If we take a look at the 3 green arrow chart, well, again, you can see we're back to 3 green arrows. The MACD is back up above its moving average, is what it looks like here. So you can see the MACD is just a smidgen. So it's not like, you know, again, we're just grinding here. We're not going to surge up to a new high. That's not typical. We typically just grind, and as long as you notice, we're still up above that 8-day moving average, and you can see the 8-day, according to the blue line here, the 8-day has stayed above the 17 this whole time. You can see how it stays above it when you're this bullish this whole time. So it's, you know, we're not close to being bearish anytime soon, and even though the stochastics is below its moving average, it's still up in the upper reversal zone, which means buyers still easily in control. We're still closing on a 5-day average basis in the 85th percentile of the 14-day range. So buyers are still easily in control. When you're close, it's one thing to close at the highs of the day, which is what this measures, versus closing at the lows of the day. And we haven't closed near the lows of the day since December, right, for a very long time. Really, these only 2 times right here were the last times that we had any kind of period at all, and those were only like 3 or 4 or 5-day periods, and that was it. If you look at today's intraday move, you can see, you know, we started off. Well, I mean, it's hard for me to really say that we had a strong move one way or the other. Today was really just a nothing day. Literally, I mean, look at how small the range was. You can see visually compared to yesterday's range, which is a little bit of a breakout move. Remember, again, we did get a new 4-week high today, and that's a, you know, 5%. You know, the rubber band is stretched out there. That's a 5% range, which on the 4-week range there, 5% of the high. Obviously closing near the lows of the day, but again, if you look at like the volume and the trading range today, as I mentioned before already, the trading range is really small, below half of the average, and then the volume at 50 million. I mean, put this in the context. The volume is way down here, below the average. Is already, you know, the average itself is at an extreme low. So same with the ATR, is also at an extreme low, and the ATR was well half of that, and the ATR on a relative basis well below 1%. The only thing that's really not participating is volatility. So you can see volatility with as small of a move as we had today. Remember, yesterday we had a big breakout move to the upside. Volatility was hardly down at all. Today we have a smidgen of a move to the downside. Volatility is up 7%. And finishing at the highs of the day today, and finishing in the upper half of the bullish range. So we never did get to an extreme low in volatility, as you would have expected, considering how much of an extreme high that we're hitting, even on a short-term basis. So to summarize, the market posture remains strongly bullish. The trend is very mature, and again, another sign of that is just how weak the pullbacks are, like today. I mean, a down day, and it was about as weak of a move as you could possibly get, and that's a sign of a strong bullish posture, obviously. And so we're not, we're as mature as this posture is, we're not threatening a pullback anytime soon. Of course, barring any unexpected headlines, which throws any of this analysis out the window. But right now, there's, while there's plenty of buyers to keep the trend going, there's not enough of an impetus or for any kind of profit taking or selling to come in to overwhelm the buyers. So in that vacuum, we grind slowly. For some people, depending upon how directionally bullish you are, it can be a really slow grind to the upside. So that's our outlook, and until we get kind of anything to change that, we persist with this, making sure that we have decent risk management. As I mentioned before, when I walk a tightrope, I've used this analogy before. When I walk a tightrope that's only 3 inches off the ground, I can walk across it, no big deal. Even if it's 3 feet off the ground, I can still walk the tightrope, and if I fall, I land on the ground, no big deal. But when I'm walking a tightrope that's 30 feet off the ground, which is like what we are right now, it doesn't mean that we can't do it, and it doesn't mean that that we can't get across, right, and succeed and this trend continue. But it does mean that the risk is different than it was back in early December. The risk is a lot higher now because of the downside potential that we didn't have in December because of how extremely oversold we already were at the end of December. So it kind of puts that into context and just means that, okay, as I continue to ride this trend, I recognize the rising risk factors and account for them, and how I manage risk in any new existing trades, how I add to my risk with really cheap protection now on my current portfolio, and then balance my active trading account so I'm not caught one-sided in either direction, one way or the other. So what do you think? Do you agree with that outlook assessment? Do you disagree? Vote now by clicking click that link that's popping out up there. It opens up a poll, then hit either agree or disagree. If you click disagree, scroll to the comment section below. Comment down there on anything that you see that would suggest otherwise from what we talked about here tonight. All right, now let's talk about what's driving the price action today. And of course, not a lot going on from a calendar perspective. If I take a look at the calendar here, you can see in petroleum status report was really the only thing scheduled. Obviously, we have different earnings announcements. You can see oil inventories continue to move higher. A little bit of a draw last week, but look how we're trending higher. And that's the time of year. That's pretty typical. Tomorrow we'll get durable goods orders. From an economic perspective, we're still, in fact, look at the odds for rate cuts are ramped back up pretty big today. We were just a week ago, we were at 57% odds that we'd stay here by the end of the year. Now we're less than 40%. So the odds of a rate cut have jumped back up above 60. Now when it gets above 80 and stays there, that's the concern. That's when the Fed is, the market's pricing in the Fed dropping those interest rates, and that's not necessarily the case yet. But you can see today the biggest mover today was long-term bonds, real estate, and the dollar up as well. But look at the move higher, and you can see what it did on the 10-year yield, at least after having a nice little bit of a rally and a little bit of a strong bullish posture here. We're rolling back over back to the downside, closing below the low of the high day. The dollar made an interesting move, closing finally for the first time up above $98. That's a significant breakout on the dollar, and if that holds, then that means that's a change, right? Of course, it's not because of U.S. economic growth expectations, not because yields are rising. It's mainly because of what's going on globally. As you can see, we're getting a cluster today, and the days has barely started on the currency contracts. But that's a pretty steep continued drop on the euro US dollar, and you can see the pound also continuing with multiple clusters as we're on this strong bearish trend. And then finally the Aussie US dollar, you can see how it's turned bearish with a little bit of a breakout move. So really all these other currencies are declining sharply against the dollar, and that's propping the dollar up, even if yields here aren't rising or interest rate hike odds definitely aren't right. In fact, interest rate cut odds are rising. So when you put all those fundamental factors, that's all pretty bearish for the dollar, but it kind of shows how bearish we are globally. And it's just a reminder, you know, here we've had this nice little rally in stocks on developed markets as well as emerging markets. But you see the pullback here in emerging markets. They struggle from the strong dollar. It's just a reminder that things aren't as bullish as we are here from an investment standpoint, an equity standpoint. Globally, things are pretty darn bearish. That's why those currencies are falling as hard as they are, and that's why the dollar is rising as much as it is. That will put pressure on international stocks if that breakout in the dollar holds. Won't necessarily put pressure on U.S. stocks. It just will mean that it will put pressure on certain areas in U.S. stocks, like the energy sector, which has been trying to bounce up, the industrial sector, which has been trying to bounce up. Those sectors benefit from a weaker dollar and would struggle more whenever there's a stronger dollar. In fact, you can see here at the very bottom, I mean, the $3 sensitive sectors, or the weakest sectors on the day. In fact, those are the only ones that underperform the market. On the other end of the spectrum, higher real estate helped keep real estate up, even though, you know, it's kind of below. It's got this weak bullish posture, and it's below the moving average. Utilities also strong bearish posture, and also below a falling moving average, so it's red. Healthcare also below a falling moving average with a weak bullish posture, so light green. You can see materials has finally turned red, and energy is still very, very weak after a little breakout a couple of days ago. Complete reversal today. So as bullish as we are with clusters on communication services and technology and discretionary, not everything is as bullish, and we see that reflected in some this decreasing correlations among all these sectors, with weakness in a lot of these areas, but especially these dollar sensitive. But technology, you know, in a strong dollar environment where the markets stay bullish, technology does better in that type of environment. One stock in this technology sector is Sienna. Sienna, a lot of these stocks have been doing really well here lately, and you can see Sienna finally turning up, getting this intermediate line, getting above 50, which gives it the dark green shading there. But you can also see too, we go from 38.12 to 38.13, which means tomorrow the moving average will be green, dark green. So that's a good bullish combination for a potential trend to develop. You can see from a 3 green arrow standpoint, we do have 3 green arrows, and while the volume wasn't 1.5 times, it was really darn close yesterday when we actually got the 3 green arrow signal. And then today, above average volume on the day, we had very, very, very light volume. So that kind of says a lot there about its volume. If you take a look at the two, when you break out the MACD and stochastics, you can see the 8 and 17 crossing above the 30. You can also see the MACD, you know, kind of hiccuping there at 0, and now getting easily up above 0. The stochastics getting above 50, both above rising moving averages. Bullish patterns there. If you take a look at the Bollinger Bands yesterday on that 3 green arrow signal that almost had the 1.5 times average volume, you can see we did close above the upper Bollinger Band down there. Not to an extreme where you say, okay, now we're going to peak and kind of go sideways, and here it actually went down a little. But when you have low bandwidth and you break out with, you know, just up above that upper band or lower band if you're trending lower, that's a pretty decent sign. And you can see kind of some support, volume support that we're bouncing off of here and breaking out and getting up to new highs. If you take a look at the DMI for Sienna, you can see the positive sign, the positive crossing up above 26 yesterday and today. The negative line crossing below 20 today, so that's a good bullish combination. You can see the ADX, which had been relatively strong, in this case to the downside, is now turning back up to the upside. If you take a look at the long-term view of the stock, you can see it has been pretty bullish for a while. So I don't know if I necessarily want to start like a new trend trade, especially with the market itself very mature on this current intermediate run. But definitely it's got some legs for a short-term bullish trade. It's got some bullish momentum, considering that this is one of the few sectors that still is kind of driving higher, while some other sectors are showing some weakness. So, you know, how can we trade this? Again, there's only 23 days left till May expiration. If you go out here to the Bollinger Bands again, to give ourselves a little bit of time. You can see the earnings announcements coming after that May expiration. So I can look to sell this $39.5 strike price by the 37.5. That gives me plenty of credit. Right around this 47 cents is all I need. And of course, the break even is this line here. Essentially, we'd have to nullify yesterday's breakout move and get back below yesterday's low point for us to get to a point where we'd take a loss equal to what we're trying to make, which is what we're willing to take, right? That's how much of a loss that we're willing to take. Actually, a little bit more than that, to that $50 level. Whatever we're trying to make is what we're willing to risk before we cut that loose. So, and because of that earnings, because of earnings not being so imminent or after expiration, we can position size normally here without having to account for that risk factor of an earnings announcement. Alright, so that wraps us up for today, and now I want to hear from you. Remember to use that link up above the video. You can also click that link popping out up there in the top right corner of your screen. That takes you to our forums. Open up any new thread with any questions or comments you have on anything we talked about in the video, or any new thread on anything we didn't talk about. If you just want our take, or you want to be able to start a discussion in our community. Remember, you can also reply to other people's threads there as well. You have to subscribe to our site to be able to participate there, but you can do that for free, as I showed you before. Thank you again for watching tonight. Remember to subscribe to our YouTube channel, click the thumbs up icon, and comment on the video. Follow us on Twitter for more content in between videos, and join our community on our website at marketscholars.com, as well as the community we created on Facebook. Have a great rest of your evening, everybody, and we'll see you all next time.